Assalamualaikum warahmatullahi wabarakatuh to Sir Azhan. So this is my group turn. So we from the group 9. So we choose about ajinomoto berhad. Before I forget, my name is Muhamad and my match number is UDE 210151. So how and why we choose ajinomoto berhad? So I story about introduction ajinomoto. So we go first. Ajinomoto is a Japanese multinational food and biotechnology corporation which produce seasoning international insertion material for semiconductor package for use in personal computer, cooking oil, frozen food, beverage, sweeteners, amino acid, and pharmaceutical ajinomoto. And sense of taste is the trade name for the company original monosodium glutamate (MSG). The first of its kind since 1909, the corporation head office is located in Tokyo. So, Ajinomoto was created in 1908 as a subsidiary of Suzuki Pharmaceutical, which was found in May 1907 by Saburosuke Suzuki II and Kikone Ikeda. Ajinomoto was created to lead Ikeda, a professor at Tokyo Imperial University. Cell monosodium glutamate seasoning made from wheat that be invented and patented. He created a seasoning after discovering that MSG was the source of a flavor that he called umami. In April 1909, Ajinomoto present Ikeda's seasoning under the brand name Ajinomoto at the new product exhibition event in Tokyo and began selling the product the next month. Ajinomoto primarily market as a seasoning to housewife by using their trademark, a housewife in an apron, in newspaper advertisement, on signboard, and on group stamp. So, in 1914, Ajinomoto built a new factory in Kawasaki to expand its production of flavoring. Japan improved economy after World War I, resulted sales reaching 1,563,000 yen in 1918. Despite rising sales, Ajinomoto experienced a deficit during the first 10 years due to altering its method of production and lowering its price to get its product into ordinary household, among other seasons. So, Ajinomoto modified Ajinomoto recipe by using amino acid from sugar cane instead of soybean, which allowed seasoning to be produced locally in the country it was exported to, which reduced shipping costs for the company. In 1956, the company began supplying certain amino acid for pharmaceutical use, contributing to the world's first release of amino acid enforcing. In 2010, due to a rise of foreign competition, Ajinomoto began structuring to focus on revival of its product while divesting other. The company divested a capsule beverage unit in Japan in 2012. The Ajinomoto Sweet Company in October 2015 and Amoy Food China in November 2018. And Ajinomoto also decided to focus on its food and biomedical division and acquired the contract manufacturing organization Azhan Technology in 2013, and frozen food company with a holding in 2014, and the food frozen company France in 2017. So last one. In December 2011, Ajinomoto announced it had begun construction to expand its Kawasaki plant along with the construction of a new R&D building. In December 2020, Ajinomoto was included by CDP in its climate change list from 2020 for the first time as one of the most outstanding companies in terms of climate change related innovating and information disclosure for the climate impact. So it's all about introduction ajinomoto berhad. So about why we choose ajinomoto berhad. So we go to the finding all about Sir Azhan give part A and part B. So it's all about me. Thank you.
Hi and Assalamualaikum Sir Azhan. My name is Muhammad Danish Aiman bin Muhammad Mahathir. My matrix number is UDE 210146, and for this part of the video, I will be explaining about the process in finding the policy, performing the asset situation related to the property, plant and equipment. This policy of measuring the recognition and derecognition of the property, plant and equipment can be found on Ajinomoto's 2020 annual report. Okay, let us start with the content of it. All items of property, plant and equipment are initially recorded at cost. The cost of an item of property, plant and equipment is recognized as an asset if and only if it is probable that future economic benefits associated with the item will flow to the company and the cost of the item can be measured reliably. Subsequent to recognition, property, plant and equipment are measured at cost less accumulated depreciation and accumulated impairment losses. When significant parts of property, plant and equipment are required to be replaced in intervals, the company recognizes such parts as individual assets with specific useful lives and depreciation, respectively. Likewise, when a major inspection is performed, its cost is recognized in the carrying amount of the plant and equipment as a replacement if the recognition criteria are satisfied. The carrying value of the replaced part is derecognized. All other repair and maintenance costs are recognized in profit or loss as incurred. Freehold land has an unlimited useful life and therefore is not depreciated. Leasehold lands are depreciated over the period of their respective lease term. Depreciation is computed on a straight line basis over the estimated useful lives of the assets. According to Ajinomoto Malaysia Berhad, the estimated useful lives of a non-current asset, such as buildings, are between 4 to 15 years. The estimated useful lives of motor vehicles are around 6 years. The estimated useful lives of plant, machinery and equipment are between 4 to 15 years. And the estimated useful lives of furniture, fixtures and fixings are around 10 years. Capital work in progress, which includes property, plant and equipment, is not depreciated because the assets are not yet ready for use. The carrying value of property, plant and equipment are reviewed for impairment when event or changes in circumstances indicate that the carrying value may not be recoverable. The residual value, useful life, and depreciation method are reviewed at each financial year to ensure that the amount, method, and period of depreciation are consistent with previous estimate and expected pattern of consumption of the economic benefits embodied in the property, plant and equipment, and adjusted prospectively if appropriate. An item of property, plant, and equipment is derecognized upon disposal or when no future economic benefits are expected from its use or disposal. Any gain or loss on derecognition of the asset is included in the profit or loss in the year the asset is derecognized. Thank you very much.
Hi, Assalamualaikum. My name is Muhammad Alif Haikal bin Azhan and my matrix number is UDE 210177. And me myself is from UDE 21 section 2. And for this group presentation of financial accounting and reporting 3, I will explain for part A about the question that state like A. Find out the policy of measuring the recognition and their recognition and also subsequent measurement concerning. So for my part, for part A, I will explain about the inventories where the inventories in Ajinomoto, Malaysia Berhad. So first of all, the inventories in Ajinomoto, Malaysia Berhad are split at the lower cost and net realizable value. Next, cost incurred in bringing the inventories to their present location and condition are accounted for as follows. So first of all, the raw materials in Ajinomoto, Malaysia Berhad, the purchase cost on a weighted average method. So next, the finished goods and work in progress in Ajinomoto, Malaysia Berhad, the cost of direct materials and labor, and a proportion of manufacturing overhead based on normal operating capacity. These costs are assigned on a weighted average method like raw materials. And next, the net realizable value is the estimated selling price in the ordinary cost of business less the estimated cost of completion and the estimated cost necessary to make the sales for Ajinomoto, Malaysia Berhad. So next, weighted average is a calculation that takes into account that varying degrees of importance of the number in a dataset. In calculating a weighted average, each number in the data set is multiplied by a predetermined weight before the final calculation is made. Ajinomoto, Malaysia Berhad also integrate the amount of weighted average at the end of the year 2020 in their financial statement under current assets, which helps the user gather a more accurate look at the dataset. The set of data that than the normal average alone, the accuracy of the numbers you arrive at with this method is determined by the weight you give specific variables in the datasets, as if the company is performing well or not when it comes in handling their inventory item. So that's all for part A, where I explained about the inventories in Ajinomoto, Malaysia Berhad. The statement that for part A is about the policy in inventories of Ajinomoto, Malaysia Berhad.
Hi, my name is Anak Kuyong. My metric number is UDE 210114. Today, I will present about policy of measuring the recognitions and derecognitions and about subsequent measurements about account receivable. So I will proceed. Trade receivables are not interest bearing and are generally on 14 to 19 day term. They are recognized that are either past due, no impaired, creditworthy debtor with solid payment record with the company, are trades and other receivable that are either past late, no impaired. Receivable that are past due but no impaired at the reporting date. The company has trade receivable of RM 16,335,325. They were past due but no impaired. Trade receivable for export sale of RM 145,999 has been arranged to be settled via letter of credit provided by reputable banks in the country where the customer are located of the reporting date. At the reporting date, trade receivable secured by bank guarantee total RM 533,188 ringgit. The remaining receivable amount is unsecured in nature and pertain to customer who has been default on payment but are slow paymaster and they are thus monitored on a regular basis. For impairment, at each reporting date, an impairment analysis is performed using a provision metric to calculate ECL. The provision rate are calculated using day past due of group of customer that has similar loss record. Example, geographical region and product type and coverage by letter of credit or other form of credit insurance. The competition consider the probability weighted outcome, the time of value of money, the reasonable or supportable knowledge about previous event, current situations, and future economic condition that is known at the reporting date. The provision metric is initially based on the company observes default rates in the past. The historical observes default rates are updated and changed in the forwards. Looking estimate are examined of each reporting date. In MFRS 9, classification of financial asset. The entity business model are managing financial asset. Identity business model is determined at the level that reflects how growth of the financial asset are managed together to achieve a particular business objective. The identity business model does not depend on management intentions of the individual instruments. Accordingly, the conditions is not an instruments by instruments approach to classifications and should be determined on the higher level aggregations. However, a single entity may have more than one business model for managing its financial instrument. Subsequently, classifications need not be determined at the reporting entity level. For example, an entity may hold a portfolio or investment that is managed in order to collect contractual cash flow and other portfolio of investment that is managed in order to trade to realize fair value change. Similar, in some circumstances, it may be appropriate to separate a portfolio to financial assets into sub-portfolio in order to reflect the level at which its entity matches to financial asset. For example, there may be the case if a detainee originally or purchased a portfolio of mortgage loan and manage some of the loan with the objective of collecting contractual cash flow and manage the other loans with objective of selling them.
Very good day, Sir Azhan. My name is Tharshan and my matrix number is UDE 210131. So now I will first talk about the part A, which is on the scenarios of plant, property and equipment on ajinomoto Berhad. So all items of property, plant and equipment are initially recorded at cost. The cost of an item of property, plant and equipment is recognized as an asset if and only if it is probable that future economic benefits associated with the item will flow to the company and the cost of the item can be measured reliably. Subsequent to recognition, property, plant and equipment are measured at cost less accumulated depreciation and accumulated impairment losses. When significant parts of property, plant and equipment are required to be replaced in intervals, the company recognizes such parts as individual assets with specific useful lives and depreciation, respectively. Likewise, when a major inspection is performed, its cost is recognized in the carrying amount of the plant and equipment as a replacement if the recognition criteria are satisfied. The carrying value of the replaced part is derecognized. All other repair and maintenance costs are recognized in profit or loss as incurred. Freehold land has an unlimited useful life and therefore is not depreciated. Leasehold lands are depreciated over the period of their respective lease terms. So the first scenario here, depreciation is computed on a straight line basis over the estimated useful lives of the assets as follows: buildings 4 to 15 years, motor vehicles 6 years, plant machinery and equipment 4 to 15 years, furniture, fixtures and fittings 10 years. Capital work in progress, which includes property, plant and equipment, is not depreciated because the assets are not yet ready for use. The carrying values of property, plant and equipment are reviewed for impairment when events or changes in circumstances indicate that the carrying value may not be recoverable. The residual value, useful life and depreciation method are reviewed at each financial year end to ensure that the amount, method and period of depreciation are consistent with previous estimates and expected pattern of consumption of the economic benefits embodied in the property, plant and equipment and adjusted prospectively. If appropriate, an item of property, plant and equipment is derecognized upon disposal or when no future economic benefits are expected from its use or disposal. Any gain or loss on the recognition of the asset is included in the profit or loss in the year the asset is derecognized. So the second scenario here on property, plant and equipment is that Ajinomoto Berhad acquired a cargo van for a total of 120,000 on 1st January 2020. Depreciation computed on a straight line basis over the estimated useful lives of the cargo van is at 6 years of useful life. The company used a revaluation model to value the vehicle and a professional valuer was of the opinion that the fair value of the cargo van at the end of year 2020 is 105,000 ringgit. So Ajinomoto Berhad can integrate the depreciation of its cargo van into the statement of financial position under the non-current asset column since the useful life of the vehicle is more than 1 year to show the cost of the asset with the benefit of its use over time. Depreciation of the cargo van represents how much of the assets value has been used, which allows companies to earn revenues from the assets they own by paying for them over a certain period of time. Ajinomoto Berhad can also integrate the revaluation surplus of its cargo van into the statement of changes in equity under the revaluation surplus column. A revaluation surplus is an equity account in which is stored any upward changes in the value of capital assets, or in Ajinomoto Berhad case, the changes in value of its cargo van. If a revalued asset is subsequently dispositioned out of a business, any remaining revaluation surplus is credited to the retained earnings account of the entity. So that's all for part A. So
Hi everyone, my name is Tengku Danial Afroze bin Tengku Nazwa Naim, and my matrix number is UDE 210128. So, before we start, I will ask, what is inventory? Inventory is the accounting of items, company parts, and raw materials that a company either use in the production or sales. As a business leader, you practice inventory management in order to ensure that you have enough stock on hand and to identify when there is a shortage. Okay, the verb inventory refers to the act of counting or listing items. As an accounting term, inventory is a current asset and refers to all stock in the various production stage. By keeping stock, both retailers and manufacturers can continue to sell or build items. Right. Inventory is a major asset on the balance sheet for most companies. However, too much inventory can become a practical liability. An organization's inventory, which is often described as the step between manufacturing and order fulfillment, is central of all of its business operation, as it's often serve a primary source of revenue generation, regardless of the fact that inventory can be described and classified in numerous ways. It's ultimately its management that directly affect an organization's order fulfillment capabilities. For example, in keeping track of raw materials, safety stock, finished goods, or even packing materials. Businesses are collecting crucial data that influences their future purchasing and fulfillment operation. Understanding purchasing trends and the rates at which items sell determines how often companies need to restock inventory and which items are prioritized for repurchase. Having this information on hand can improve customer relations first. Second, cash flow, and the last can profitability, while also decreasing the amount of money lost to waste inventory, stockouts, and restocking delays. Alright, there is 13 type of inventories, which is raw materials, component, work in process, which is WIP, finished good, maintenance, repair and operation goods, which is MRO goods. Okay, packaging and packaging materials, safety stock and anticipation stock, decoupling inventory, circle inventory, service inventory, transit inventory, theoretical inventory, excess inventory. In this situation, according to a report by Ajinomoto Malaysia Berhad, finished good inventory are reported at a lower cost and net realizable value for raw material, finished good, and work in process, which is WIP. The expenses incurred to bring the inventory to its current inventory and condition are calculated using the weighted average technique. Ajinomoto Malaysia Berhad, for example, purchased raw material in 2020 to make distribute the popular popular flavor enhancer Ajinomoto. On 1st January 2020, the initial inventory of Ajinomoto will be 10,000 kg with a total cost of 40,000 ringgit, which is 4 ringgit per kg, and a selling price of it is 7 ringgit per 1 kg bag. For the best inventory best practice, the business say if you can't measure it, you can't manage it. Apply to inventory management and best practice. Okay, why? The first best practice is keeping track of your inventory. Other includes: first, carry safety stock, also known as a buffer stock. This product help keep companies from running out of material or high demand items. Once company deplete their calculated supply, safety stock serve as a backup should be level of demand increase unexpectedly. Alright. Then invest in a cloud-based inventory, which is invest in a cloud-based inventory management program, which is cloud-based inventory management system let companies know in real time where every product and SKU are located globally. This data helps an organization be more responsive, up to date, and flexible. Then, moreover, start a cycle count program, which is cycle counting benefit extend well past the warehouse by keeping stock reconciled and customers happy while also saving business time and money. Then, last but not least, use batch or lot tracking, recording information associated with each batch or lot of a product, while some businesses log precise details such as expiration date that provide information about their products, sellable dates. Companies that do not have perishable good use batch or lot tracking to understanding their product landing cost or shelf life.
Hi, my name is Muhammad Danish bin Fadli. My matrix number is UDE 210176, and I will talk about trade receivable amount billed by a business to its customers when it delivers goods or service to them in the ordinary course of business. These billings are typically documented on formal invoices, which are summarized in an accounts receivable again report. This report is commonly used by the collections staff to collect overdue payment from the customers. Ajinomoto Malaysia Berhad can integrate the value they receive from their business under trade receivable and bank account in journal entries since the customer has paid the amount of the service, which this will show that Ajinomoto Malaysia Berhad is capable to run any ongoing operating expenses and fund other day-to-day business operation, which will also increase Ajinomoto Malaysia Berhad company value or benefit the company operation. Current assets, which are expected to be converted to cash in the coming year, assets are in addition to trade receivables. Current assets also include items such as cash equivalents, stock inventory, and prepaid liabilities. A company receivable may include both trade and non-trade receivables, with the latter including receivables which do not arise as a result of business sales, such as tax refund or insurance payout. Non-trade receivables are also typically recorded on the balance sheet as current assets. Trade receivables or account receivable are the opposite of account payable, which is the term used when a company owes money to its suppliers or other parties. To give an example of the receivables, a company might invoice its customers 475 ringgit for the sale of material. Under double entry accounting principles, the company will credit the sale account by 475 ringgit while also debiting the trade receivable account by the same amount. Once the customer has paid the bill, the company will credit the trade receivable account by 475 ringgit and debit the cash account. The situation is, according to Ajinomoto Malaysia Berhad, trade receivables are non-interest bearing and are generally on 14 to 19 days terms. They are recognized at their original invoice amount, which represent their fair values on initial recognition. As examples, Ajinomoto Malaysia Berhad manufacture and sell monosodium glutamate MSG. The company also produce consumer food products such as food seasonings, flavors, salt and pepper, and sago starch. One of the highest requested food products that are in need from Ajinomoto Malaysia Berhad is the monosodium glutamate (MSG). Recently, on 1st January 2020, Ajinomoto provide the monosodium glutamate MSG worth 35,000 ringgit to Giant, one of the most popular hypermarket and trade retailer chain in Malaysia. Giant promised to settle the payment of 35,000 at the end of the month.
Lights, camera, action.
Hai, Assalamualaikum warahmatullahi wabarakatuh. Again to Sir Azhan. It's me, Muhamad Naqiudin. My number is UDE 210155. So we go to part 2. So the question first, does all assets have same definition? So I tell about you about this asset. So asset can be anything of value owned by individual or organization, and they can be categorized in different way. Personal asset usually include cash and cash equivalents, real estate and land. Personal properties such as car, boat, jewelry and investment. So for organization, assets usually help sustain production and growth. They usually categorized and expressed in terms of their cash value on financial statement. So how asset works? How? So asset work keeping track on asset in an estimation part running a business, but it's important for both individual and organization to take an inventory of them. If you want to protect yourself or your business, you need to know what asset you have and how much they're worth in order to get them insured. In addition, lender may take many of your assets into consideration when deciding to approve a loan, and they may even be used a collateral. So next, when it comes to business, assets are usually classified by convertibility, is current or fixed asset, physically extension, tangible or intangible asset, and usage operating or non-operation asset. So we go one by one. So first we go current asset. What is current asset? Current asset are items that are currently cash or expected to be turned into cash into 1 year. For a business, they may include cash, inventory, and account receivable. Fixed assets are those tangible physical assets acquired to carry on the business of company with a life exceeding 1 year. Example may include land, building, vehicle, boat, aircraft, tool, machinery, computer, hardware, mobile phone, and other equipment. So lastly, we go to the tangible and intangible asset. First, intangible assets exist in physical form. They usually include cash, investment, land, building, inventory, car, truck, boat, and other valuable. So intangible assets don't exist in physical form. They may include items such as brand name, distribution network, patent, proprietary processes, and methodology and copyright. So lastly, current and fixed assets usually fall into the category tangible asset. Intangible assets do not appear on balance sheet, but depending on the business, they may make up substantial part of asset value of a business. So it's all about how asset work. So now you know how the asset is work. So I will pass to my group about the other question. So thank you. So give me part this for presentation.
Okay, so before I answer the question, can you differentiate between the property, plant, and equipment? Firstly, we need to know what even is the property, plant, and equipment. The property, plant, and equipment are physical or tangible assets that are long-term assets that are typically have a life of more than 1 year. Examples of property, plant, and equipment, or as short PP&E, including vehicles like trucks, office furniture, machinery, buildings, and undeveloped land. The property, plant, and equipment assets are also called fixed assets, which are long-term physical assets. Industries that are considered capital intensive have a significant amount of fixed assets, such as, let's say, oil companies, auto manufacturers, and steel companies. Fixed assets have a useful life assigned to them, which means that they have a set number of years of economic value to the company. Fixed assets also has a salvage value, which is the value remaining at the end of the asset's life. Salvage value is also called scrap value. Meanwhile, fixed assets undergo depreciation, which divides the cost of fixed asset, expensing them over their useful lives. Depreciation helps a company avoid a significant cash outlay in the year the asset is purchased. Depreciation also helps spread the asset's cost out over a number of years, allowing the company to earn revenue from the asset. So, can you really differentiate between the property, plant, and equipment? To answer the question, based on a countless hour of researching that I did, honestly, my conclusion is no. The property, plant, and equipment cannot really be differentiated between them. The reason being is that the property, plant, and equipment have the exact same impact on investors. Companies that are expanding may decide to purchase fixed assets to invest in the long-term future of the company. These purchases are called capital expenditure and significantly impact the financial position of a company. Whether a portion of available cash is used or the asset is financed by debt or equity, how the asset is financed has an impact on the financial viability of the company. It's important to know where a company is allocating its capital, whether the company is making capital expenditures, and how the company plans to raise the capital for its project. If new equity is issued, the stock price might decline due to the dilution of the shares. If cash is used, the company may be unable to pay dividends in future quarters. If the company obtains financing from a bank or private equity firm, the company will have debt servicing costs associated with the additional long-term debt. The bottom line is, the property, plant, and equipment are the long-term tangible assets that a company owns that are most often than not fixed assets. The property, plant, and equipment, which includes trucks, machinery, factories, and land, allows a company to conduct grow its businesses. The property, plant, and equipment is depreciated over time and can be sold for its salvage value. When a company purchases PP&E, which is property, plant, and equipment, it is known as a capital expenditure. Proper management of capital expenditures is crucial to the growth and profitability of a company. So much so that investors analyze how a company manages its PP&E to determine if its capital expenditures will aid its success or be a drain on its funds. Thank you very much.
So now we're moving to part B. The part B, the question states, does intangible assets consist in non-current assets? So for the company of Ajinomoto Malaysia Berhad, I cannot agree that the intangible assets can be consist in non-current assets. The definition of intangible assets are about the business assets that do not have a physical existence, and the non-physical existence of these assets help the inflow of economic benefits. The example of these assets includes copyright, patent, license, goodwill, and trademarks that help bring inflow of economic benefits in the business. As we understand that the assets like goodwill, patent, and copyright are expected to last for a longer period than a year. Hence, intangible assets are non-current assets. Intangible assets are recorded in the business balance sheet, and these assets are stated at cost less accumulated amortization and impairment. To be recognized as an intangible asset, it must be separable, identifiable, non-monetary, and without physical existence. Intangible assets are always non-monetary in nature. It means the business is not entitled to receive a fixed amount on the sale of the assets. So, it's different from bank account and long-term investment where business is entitled to receive the fixed amount. So, intangible assets may have some market, but that cannot be financial market. Intangible assets are mostly technology-based businesses and cannot be touched. For instance, software and patents are intangible that cannot be touched. However, these assets help the business in the efficient management of the activities. Initially, intangible assets are recorded at cost. However, amortization is charged with the time. And assets are presented net of accumulated amortization and impairment. Further, the business can value the assets at fair market value, but there should be an active market for the assets to be recorded at fair value. So, in conclusion of the intangible assets are separable, non-monetary, and without physical substance. These assets may be internally developed or acquired from another businesses. If the businesses internally develop the intangible assets, certain criteria need to be fulfilled. Otherwise, the cost incurred in developing an asset is charged in the income statement under the head of research expenses. Initially, intangible is valued at the cost incurred in the case of development. Similarly, intangible purchases are valued at the price paid. Once intangible are recognized in the book of account, amortization is charged. However, if the life of an asset cannot be estimated, no depreciation is charged, but impairment is assessed annually. So for that, it is done for my part in part B and for all of my part in this presentation, and thank you.
Next, for impair on transactions, identity should cease or compromise the credit risk on initial recognitions by considering all reasonable and supportable information that is available without undue cost of effort. Entity is now required to overtake exhaustive search for information with determining at the date of transaction whatever there have been significant increase in credit risk seen in initial recognitions. If an entity is unable to make these determinations without undue cost or effort, paragraph in order to determine the loss allowance on financial instrument initially recognizing a loan commitment or financial guarantee contracts to which the entity become a party to the contract. To the date of initial applications, both on transition and until the recognitions of this item, and entity shall consider information that is relevant in determining of the credit risk in initial recognitions. In order to determine initial credit risk, identity might consider internal and external informations, including portfolio informations, in accordance with paragraph B 5.5.1 until B 5.5.6, B 7.2.4. Identity will be little historical information may be used, information from internal report and statistic that may have been generated with daily things whenever to launch a new product. Information about similar products to peer group experience for comparable financial instrument if relevant. For part 2, my question is, how does inventory are recorded in the corporations? Inventory is recorded and reported on the company balance sheet all its costs. When an inventory item is sold, the item cost is removed from inventory and the cost is reported on the company income statement as the cost of goods sold. cost of goods sold is likely the largest expense reported on the income statement. Inventory purchases are recorded on the operating account with the inventory object codes, and sales are recorded on the operating account with the appropriate sales object codes. A sold of goods sold transactions is used to transfer the cost of goods sold to the operating accounts. Next, inventory is the assets at its ending balance in reports in the current assets sections of the company balance sheet. Inventory is not an income statement account. However, the change in the inventory is a component in the calculations of the cost of goods sold, which is often present on the company income statement. That's all for me. Thank you.
Part B is about how does the FIFO method, which is first in first out, can benefit corporation. So the first in first out, or commonly known as FIFO, is a system of asset management and valuation in which assets generated or acquired first are sold, utilized, or disposed of first. For tax reasons, FIFO presupposes that assets with the oldest expenses are included in the cost of goods sold on the income statement (COGS). The remaining inventory assets are matched to the most recently acquired or generated assets. To estimate the expenditure flows, the FIFO method is applied. As products progress to further stages of development and finished inventory items are sold, the associated expenditures must be reported as an expense. Under FIFO, the cost of the product acquired first is deemed to be recognized first because merchandise has been removed from the company's possession. The monetary value of the total inventory decreases throughout this procedure. Inventory costs may be calculated using a variety of approaches, including the FIFO method. Market inflation and increasing prices are both prevalent economic conditions. If FIFO is applied to the cost of goods sold in this case, the oldest cost should be priced lower than the most recent stocks collected at the current inflated price. Because costs are lower, net income is higher. Furthermore, the most recent inventory was bought at higher prices. The closing inventory balance is inflated. Inventory changes are assigned as products are readied for sale. This might be caused by the purchase of inventory or manufacturing expenses, the acquisition of resources, or the use of labor. These expenses are determined by the sequences in which the product was utilized, and in the case of FIFO, by what comes first. So for example, a company bought 100 goods for 10 ringgit each, then another 100 items for 15 ringgit each. The firm then sold 60 goods. The cost of goods sold for each of the 60 products is 10 ringgit per unit under the FIFO technique. Since the first goods acquired are the first things sold, the items value remaining 140 items in inventory is 10 ringgit per unit for 40 items and 15 ringgit per unit for 100 items. This is because the FIFO technique assigns the most recent expense to inventory. So another example, let's assume a business sells an additional 50 products from its remaining inventory of 140 units. For 40 of these things, the cost of goods sold is 10 ringgit and the whole initial order of 100 units has been sold. The remaining 10 items are worth 15 ringgit each, while the remaining 19 units in inventory are worth 15 ringgit each. The obvious advantage of FIFO is that most widely used method of inventory valuation worldwide. It is also the most exact method of connecting the expected cost flow to the actual movement of items, giving businesses a more accurate picture of inventory costs. Furthermore, it lessens the impact of inflation by assuming that the cost of obtaining fresh inventory is higher than the cost of acquiring older inventory. Finally, it helps to reduce inventory obsolescence. As proven, FIFO inventory control is beneficial whether you manage perishable commodities or not. This strategy assists business owners in making better use of warehouse spaces, saving money on labor, and reducing equipment wear and tear. FIFO is especially beneficial in the food and beverages industries, fashion industries, where enterprises must keep up with current trends, pharmaceutical industries, cosmetic industries, and electronic industries, where items may become outdated. FIFO is often used by companies that export products to meet with International Financial Reporting Standard, or in short, IFRS. So that's all on part B, and that's all from me too. Thank you.
Alright, the question is, does every corporation need to have financial instrument? So first we need to know is, what is a financial instrument? Financial instrument are assets that can be traded, or they can also be seen as packages of capital that may be traded. Most type of financial instrument provide efficient flow and transfer of capital all throughout the world's investor. Okay, this asset can be cash, a contractual right to deliver or receive cash, or another type of financial instrument, or evidence of one ownership of an entity. Financial instrument can be real or virtual document representing a legal agreement involving any kind of monetary value. Equity-based financial instrument represent ownership of an asset. Debt-based financial instrument represent a loan made by an investor to the owner of the asset. So, for me, the answer is not every corporation need to have financial instrument, because the use of financial instrument can reduce exposure to certain business risks. For example, change in exchange rate, interest rate, and commodity price, or combination of those risks. On the other hand, the complexity inherent in some financial instrument can also result in increased risk. That's all from me. Bye.
Based on the question, is it better to have financial asset or current asset? My answer is current asset, because current asset represent all the assets of a company that are expected to be conveniently sold, consumed, used, or exhausted through standard business operations with 1 year. Current assets appear on a company balance sheet, one of the required financial statements that must be complete each year. Current assets are balance sheet assets that can be readily converted into cash within 1 year or less. Because current assets include stock and cash equivalents, anything that has the liquidity to turn into cash will be recorded as a current asset in the balance sheet. It is important to understand that not all current assets on the balance sheet are equal, as they vary depending on the type of business you operate. When recording current assets on the balance sheet, they are usually displayed based on the order of liquidity. the easier they can be converted into cash. The higher up on the balance sheet they will be placed. Current assets would include cash, cash equivalents, account receivable, stock inventory, marketable securities, prepaid liabilities, and other liquid assets. Current assets may also be called current accounts. Current assets are important to business because they can be used to fund day-to-day business operations and to pay for ongoing operation expenses. Since the term is reported as a dollar value of all the assets and resources that can be easily converted to cash in a short period, it also represents a company's liquid asset. However, cash should be taken to include only the qualifying assets that are capable of being liquidated at a fair price over the next 1 year period. For instance, there is strong likelihood that many commonly used fast-moving consumer goods (FMCG) goods produced by a company can be easily sold over the next year. Inventory is included in the current assets, but it may be difficult to sell land or heavy machinery, so these are excluded from the current asset. Depending on the nature of the business and the product it markets, current assets can range from barrels of crude oil, fabricated goods, works in progress inventory, raw material, or foreign currency. Thank you.
Last question, what is contingent asset? A contingent asset is a potential economic benefit that is dependent on some future event largely out of company control. A contingent asset is those also known as potential asset. Not knowing for certain whether this gain will materialize or being able to determine their present economic value means this asset cannot be recorded on the balance sheet. However, they can be reported in accompanying footnotes of financial statement provided that certain conditions are met. A company involved in a lawsuit that is expected to receive compensation has a contingent asset because the outcome of the case is not yet known and the dollar amount is yet to be determined. Let's say company 1 have filed a lawsuit against company 2 for infringing a patent. If there is a chance the company A will win the case, it has a contingent asset. This potential asset will generally be disclosed in financial statement but not recorded as an asset until the lawsuit is settled. Okay, it's all from my group about ajinomoto berhad, and we all answer all questions from Sir Azhan. Okay, thank you from Sir Azhan give us space to present to you about our explanation and our report about ajinomoto. I hope we see again to next semester and until we done for diploma. So thank you.